Hey, good.
Hey, Kevin.
What's up, Sean?
How's the train life for you?
Oh, it's miserable. We can't get any equipment.
I'm sorry, man.
Such is life.
Where's the supply chain breakdown?
Microprocessors in China.
Those dang microprocessors will get you every time.
Yep. I think they're having workforce issues too. So.
Yeah, they all got the Wuhang.
Mm-hmm.
For full disclosure, this call is being recorded for quality assurance and training purposes.
It gave a little notification when you started the recording.
Did it?
I think everyone knows.
Yeah. Well, do you wait for people or do you just start? You know?
I would wait a few more minutes, but also just so you know, I'm going to keep my computer on mute unless I'm talking because of baby sounds in the background.
Yeah. Benaiah has some contributing. He has some good input, I'm sure.
I'm sure.
Yeah. So Kevin, how's the year going for you?
Not too bad so far.
Yeah.
So, yep. I bought a short-term rental up in the mountains.
Woohoo!
Yeah. So, close on that at the end of the month.
Okay.
Gonna give it a whirl.
Is that near Asheville or?
It's on Beach Mountain.
I talk like I know where that is.
By Boone.
Okay.
But there's a ski slope there. So.
Sweet.
Yeah.
Kevin, I just met a guy who him and his investing partner have five condos in Beach Mountain. Mm-hmm. And I know it's not huge, so I'm wondering if they own some in maybe that same complex that you're buying.
Yeah. There's you see a lot of the same complexes pop up, so it's definitely possible.
Yeah. Cool. Who you got a manager? Are you self-managing?
I don't know. There's a group called Carolina Stays that I've been recommended, but I mean, everything I've read is to self-manage them just to keep the profits, but we'll see.
Yeah.
We have a friend who just bought something in Beach Mountain. And she was telling me in her research that the management fees for short-term, their average was like 30 to 35% or something crazy. I don't know if you
20% is what I've seen with the two companies I've looked at, but from what I understand, that's on that's a good thing. It is more on what you're seeing, about 30%. So
okay, at least somebody's doing 20. It's definitely higher than here for short-term stuff.
Yeah,
I'm sure a lot of management challenges doing it from afar.
Yeah. Oh yeah.
Michael, good afternoon. Welcome.
Hello. How is everyone?
Well, yourself?
Good.
Good. I'll be transitioning inside, so I'm in my car at the moment. So I'll be following along.
Okay, no worries. We'll start at 105. Give other people a little bit of an opportunity to check in case they got stuff going on. Sean, how's your portfolio life growing?
It's good. We're closing on a Buckhorn townhouse on April 15th.
Nice.
And
okay, so it finally got built. Isn't that the one that took forever?
Yeah. You remember, Avery, when Scott Schafrin got his under contract? That was like almost like a year and a half ago. So, but the builder hasn't tried to like increase the prices or anything. So we're excited about that. But
that's awesome. Yeah, that's cash flow like crazy, given the price I think you got it for and what those are renting for right now.
Yeah, we're buying ours for $137,500.
Oh my gosh.
And, yeah, I mean, I think it should rent for like $1,400, maybe more.
Yeah. What did it appraise for, or when does the appraisal happen?
It appraised for $140,000.
Okay.
Which I think like it was like a layup appraisal, I'm sure, for the appraiser, because like there's plenty of comps, but because the new ones are selling for like 175, but those won't close for months.
Sweet.
That's awesome.
Mick, welcome. Good day to you.
Hey, can you hear me all right?
Yeah, can you hear me?
Yep, I'm just dialing in from the car, so trying to get everything set up.
Yeah, you are a little quiet.
Gotcha.
All right. Well, let's just jump into it. And if people are late, that's their problem. So thank you guys for one, your business, for two, wealth building with us. We all have a passion for real estate, and it's fun to share it with people because everybody has good ideas and different experience. And I think this is going to be a good opportunity to do habitually, to learn from each other. A lot of people invest out of state, other states, and can just bring good ideas to the table, so we can really build generational wealth for our families, like I know all of you guys want to. So just kind of who's who in the zoo. Most of you guys know me and Avery. We brought an office manager on board. Her name's Philippa. You may or may not have gotten an email or a text or phone call from her. She's a huge blessing and really talented at what she does. She has a heart to help people out. So be looking for communication from her. We onboarded a vendor this year who doesn't technically work for us. He's a 1099 guy, but he's just accepting work from us. And we've been keeping him busy really since the second week of January. He does really, really good work at the most affordable price for the quality that we get. He's a husband-wife combo, and his wife is very communicative, doing all the back office stuff to make all of our lives easier and keep that maintenance cost down. Then lastly, we got two bookkeepers. We have a local bookkeeper that does our business bookkeeping, and then we have a remote team member that does all of the rents and trust accounting and bookkeeping. So that's kind of who's who in the zoo. Going to talk real quick about what the experts are saying about the market at large. Talk a little bit about the macro real estate picture here in America. A little bit about the local market. Throw you out some Cedar Ridge management stats. Talk to you guys about some preventative maintenance updates that we're going to make, and then kind of open it up to Q&A or best practices that you guys have seen from your time investing in real estate over the years. So what the experts are saying, you guys know this, there's a huge housing shortage right now. And there's four main reasons for that. One is the uncertainty of the world that all started with COVID 2 years ago. This had a lot of impacts on supply chain. We, as a global economy, changed the way we do supply chain stuff, and we haven't been keeping a large inventory of items because we've really reduced the time it takes from order to build something. What that did when everyone went home prior to COVID caused the little margin of backlog that we had to go away. So we've been scrambling as an economy since then. Some other things that are affecting that uncertainty, you guys probably know, we are now on a fiat currency. We have been since 1971. Just a little bit of economic stuff. The average lifespan for fiat currencies is 27 years. We're hitting 51 right now. So just continue to expect some turmoil, kind of macroeconomics going into this housing shortage. So another thing is home ownership trends have changed big time. Back in 2008, the average time somebody stayed in a home was 10 years. Because of the low interest rates and the uncertainty that we're in now, we're actually seeing that go to 13 years. So because people are staying put 3 years longer, less houses are coming on the market. Therefore, there's less homes to buy. You also have some more affluent people that are able to move because their jobs have gone remote that are buying second homes. So you have a much higher second home purchase clientele out there, which is taking homes away from investors and from other people that would like to relocate. All of that is causing a high inflationary market, which with the next one is, high demand, low supply. So we were building homes on pace to keep that supply demand curve steady up until about 2006. We got kind of uncareful with what we were doing. We built a lot. As you guys are aware, people crashed and burned, and then construction really plummeted. And we have not been making enough houses since 2008 to keep up with the demand. So your demand's been going like this, and your demand's been like this, and your supply has been like this since 2008. So 2020, that started to change. I don't know if you guys remember or were paying attention to Bigger Pockets back in like 2012, 13, 14. There was a big episode about millennials being the renting generation. And that further didn't help the need to build stuff. Well, millennials are now at the age where they're starting families. So what that means is they want to settle down. They've been buying houses the last couple of years. They're young and confident that they're going to keep making money. So they're okay with paying a little bit more for prices. And all of these things are helping the prices go up, even though the supply chain can't build to produce what we need right now. So we're probably going to see a low inventory housing crunch for the next probably 3 years until those things kind of even out and we see that supply demand curve kind of meet each other. Did some math with the millennials. There's about 72 of us, sadly. I have to say us because I'm in it. But there are 23 millennials right now looking for homes. It's a big chunk of people, and it's the largest generation of people that have been trying to buy a house. Talked a little bit about construction lag and those supply chain issues. So building costs obviously went up big time. COVID changed the labor market. And then a ding on millennials. We are struggling as a community at large for skilled laborers. So I was just talking with a construction company about an hour ago. They're having a tough time finding carpenters that can replace girders and do a lot of the structural work in a home. The average age of a plumber right now is 55, and it's not getting younger. So we're going to continue to see this skilled labor issue present a problem as we try to balance out that supply demand curve. What does that mean for us as investors? So it's beautiful between 2020 and now to see rents increase. About last spring, I started seeing the blue collar guy get crunched because he wasn't making enough to keep up with how rents were appreciating. And kind of at large, that's where things are going. So if you're upper middle class, you still are doing well. But if you're lower middle class, you're struggling to qualify to meet the income requirements that managers require to put in qualified people in houses. Let's see. And I can send you guys a document, all this stuff. I got stats and links if you guys want to read. A lot of my sites are, realtor stuff, Redfin, Bigger Pockets. So some stats for you guys, macro real estate investing stats. So last year, nationally, rents increased 15%. Historically, we like to see that keep up with the cost of living. So you normally should be asking, for a 3 to 7% rent increase. We've been getting away with a lot more because of that imbalance in supply demand. The national vacancy rate, believe it or not, I was shocked to see this, is actually 5.1%, which I think is pretty cool. And then a maintenance to expense ratio, something we all care about, is 10% plus capital improvements. So if you're replacing a roof or doing, replacing a water heater, appliances, it's 10% plus that. Bringing this closer to home into North Carolina, I couldn't find a rent increase average for North Carolina. We have, from a company standpoint, been seeing anything from, or getting away with anything from 10 to 22% based on the price point of the home. The North Carolina vacancy rate is at 6.3%. And then I thought this was really cool. Forbes said the number 2 area to invest in the entire United States was Raleigh-Durham, North Carolina. So that is really close to home. And I know Sean can vouch for this, and Avery and other real estate agents out there. The influx of investors we have in Eastern North Carolina from California, Oregon, Washington, is pretty cool. And then, also like, I want to buy the homes. So we do have an influx of out-of-state investors. Now, that means something that's really important. So housing markets are going to stay stable until they get flooded with investors, because investors are the first people to walk away from properties when things go south. So as we see this trend rise, we have a very stable market right now. And I think it's going to be stable for a while because of the local economics. And we haven't been a very attractive investing market for a long time. You think about the Phoenix, Arizonas, the Floridas, Ohio, Michigan, Austin, Texas. We're now getting to that point. So we're still going to be stable, I think, for a long time. But just know in your head, as you invest, the more investors that come in, the more volatile the market will become. Now, some Cedar Ridge management stats. So I'd like to just preface this with our goal for you guys and our goal for us is long-term wealth building. So what that means is preserving the property as best possible and making maintenance and improvement decisions with a 10-year minimum vision in mind. Because, I don't really care about the maintenance just this year. I care about the maintenance over a long period, because if your cash flow every year is, let's just say $4,000, and one year you got to replace a water heater, a fridge, and you got some maintenance, some drywall work because you didn't replace the water heater soon enough. You could easily eat into 1 year of cash flow with just a couple things. So managing that well is important, and that's the stance we take on doing stuff. So our vacancy rate is 5%. Our average days listed, I couldn't find this for other markets, but our average days listed for a property is 7.2. And that doesn't mean it's vacant for 7.2 days. Avery does a really, really good job getting the place, communicating with the tenants to find out, are they going to stay put or are they moving out? And that 7.2 days listed is normally with a current tenant already in place. We have no missed rents or evictions on tenants that we've placed ever still, which I think is really cool. And a testament to how Avery's put together our screening process. And then our maintenance as a percentage of rents collected is 6% right now for this year. I think that's really, really neat, and I'm proud of that stat. Next, some preventative maintenance updates. We sending out an email next week. We are going to start doing semi-annual service plans with HVACs units. So somebody's going to go out in April to service the thing. and get it ready to turn on. And then somebody's going to go out in October, November to get it ready to switch to heat. From talking with HVAC professionals, that's going to give us anywhere from 5 to 12 years more of that HVAC's life. And if anybody wants to opt out of that, just reply to the email that I send out, and I'm happy to do that. And then, does anybody know who Ken McElroy is, or McElroy? No, he's rich.
Is he Robert Kiyosaki's investor buddy?
Yeah, he's Robert Kiyosaki's real estate guy. I like a lot of his stuff. And in this market, based on everything I said, the 4 things he said that we should be doing right now is get out of cash. So make sure you're liquid enough to service your debt, but don't keep large hoards of cash. Lock in fixed debt. Something we're going to see is rents continue to go up, is you're going to get a bunch of bandwagon investors. They're going to start doing variable rate mortgages so they can cash flow for their first couple of years, and then they're going to crash because the interest rates are going to go up. So locking in fixed debt is going to help us with inflation, and you want to be investing in inflation hedge things against our dollar. So real estate and like gold, silver, commodities. And then he's a bank hater. So he says, have liquidity outside of the banks. So keep some cash under your pillow, maybe in your basement. So yeah, that's wanted to kind of keep this short. That's all I got. Like to open it up to questions, comments, concerns, good ideas. If you guys have anything. Well, don't everybody.
I saw another stat recently that I'd like to share, if that's okay, about just the local sales market, just to give everyone an idea. If you are looking to scale here, it's getting more competitive, I would say, even than last year at this time, even with interest rates going up. So from 2021 to 2022, and this is just looking at Sneads Ferry, which I think some of us have identified as a good investing market because of the rent increase. But the average sales price from February of 2021, that was $238,500. And then February of 2022, the average sales price was $289,000, which is an increase of 20%. And then the days on market, which was a very shocking stat to see in 2021, which was 17, and in 2022, in February, the average days on market was 4. So that was a decrease of 71%. So it's very competitive, especially with investors trying to purchase long-term rentals. The kind of sweet spot that I've seen is between 200,000, maybe 200 to 250, where you can still cash flow. But you're going to be competing with primary residence buyers who are desperate. They've probably missed out on 3 or 4 houses that they've fallen in love with already, and are just doing whatever it takes to get a roof over their head so they can move their family in before they PCS here. So just know it's super competitive. Now, it's still obviously possible to get offers accepted, but it's a super strong seller's market still. That's all I have.
Thanks, Sean.
I just had a question maybe you guys have an opinion on. And let me know if you can't hear me and I need to speak up. So out here, I own a property out here in California that I've talked to some people about, and they're saying they think it's going to be a major decrease in sales growth, and potentially even sales value being a negative decrease within the next couple of years. So I know we've seen 20% growth over the last 4 years. You guys have seen, I think, similar. We all know that's unsustainable, but where do you guys see both interest rates and sales prices going over the next 5-10 years? Do you think we're in for a major collapse, total shutdown, or just a slower growth curve?
Yeah. So, two things came out there that I'd like to clarify before we answer the question. Sean, you can chime in too. There's a difference between volume sold. So the percentage of houses for sale is actually going down right now because so many people are staying in place. And that's different than the price of the home. So Sean quoted a 20% increase in price, even though there's less homes being sold right now. So is your question, do we think the value of the homes is going to continue to climb?
Yep, value.
Personally, I think in Eastern North Carolina, we're going to still see a climb for a while. We're a very landlord-friendly state, which means people from all over want to invest in this place because it's a lot easier to evict somebody in North Carolina and get your money than it is in California, New York, Oregon, Washington, etc. How long that will go for, I don't know. I thought it was interesting to hear about or read about the bullish behavior of millennials, being confident they're entering in their peak earning years. And with that confidence, they're going to continue to buy things at higher prices and probably care less about the fundamentals of, am I upside down in this thing? The average American just cares about how much it costs a month. So I think with that and the millennials being the largest buying audience right now, in places like Eastern North Carolina, you're going to see a continued appreciation in prices.
Yeah.
Avery, you want to?
Yeah, I was just going to add, I'm sure Sean can back me up, but I think that's the $1 million question. Everybody's asking it, but at least from what I see, both in buyer interest here and also in rent interest, it has only been going up. And the reasons people are wanting to move here are largely based on now that they can work remote because of COVID, they want to be by the beach. So people of all age groups, young professionals that were living where they had to live in Ohio because that's where their office was, now are working remotely and want to live here. And then you have older retired people who are wanting to get out of states that are having more governance because of COVID, and they're wanting to come here to rent and buy. So I see a lot of reasons that are long-term that people want to be here. So I think, and continually with sales and with renting, there's more people that want houses than there are properties. So I think something really crazy would have to happen, which it definitely could, for the values in this area to totally drop, because there's a lot of interest from different sources and long-term reasons that people want to be here. Yeah. And then somebody asked about Section 8. Yeah, we do have several properties that are in the affordable housing category. And it's really, those are some of our best tenants. The issue that I have seen with that is that the rental rates are governed by the housing authority. So we have 10.
Did my stuff cut out?
No, Avery, you muted yourself, I think, accidentally. The last thing we heard was like the rental rates are governed by the housing authority.
Okay. I, for some reason, hit it. Yes. So you cannot just, in the way we can with normal houses, we ask higher rents and kind of push the market. You can't do that as much with Section 8 because it's limited by the government involvement and what they will allow vouchers to go for. But there's an increasing number of people that are trying to get qualified for Section 8 vouchers because they can't, like Skylar was saying, they can no longer qualify for the kind of lower to middle income houses in Jacksonville or Wilmington that they would have been able to afford. So people are looking into manufactured homes. They're squeezing large families into smaller units, and they're trying to get approved for Section 8 because of rents going up so much.
And
yeah,
Avery, it might have cut out. Did you mention that people can't get on the Section 8 list?
Yeah, they only open it up every now and then. They have a set amount of funds. And so there is a lot of interest in it right now, and they are not opening it back up because it's maxed out. Mm-hmm.
Avery, this is Michael. Are there potential investor tax benefits for a Section 8 investment that offsets the rise in rent that you would see in a traditional rental?
Sean, you may have more knowledge on that than me. My understanding is that there are tax benefits for certain target areas. So geographic spots that the government, whatever department it is, probably the housing department, has decided they want more money put into. And so they're willing to give tax breaks to people who buy there, which generally lines up with some Section 8 areas because it tends to be lower income places that have older properties that haven't been undergoing capital improvements for a while. So I think there is a lot of overlap, but I don't know specifically because it's Section 8 is the reason, or if it's just for the investing in those geographic areas. Is that what you think, Sean?
Yeah, it's called a opportunity zone, and there's some investors who get really smart with it and save a lot of money. But I don't have a bunch of experience, Michael, but generally, or I know at least in Wilmington, if you invest in an opportunity zone, which Avery hit the nail on the head, where it's like, going to be like the C class, D class areas that the city wants to rejuvenate. If you invest in there, you will be able to defer your capital gains taxes for, I believe, like 7 or 10 years. So again, I don't know the specifics, or I've never done one myself, but the government will look favorably upon it from like a cash flow perspective. Year over year, there's not a significant benefit to Section 8, just that money is like guaranteed. And as you get into like the larger houses, the monthly stipends increase rapidly. So like, I don't have the numbers off the top of my head, but I know for like 3-bedroom houses in Jacksonville, there's a big jump. And then once you get into like 4 and 5-bedroom houses in Wilmington, there's a pretty remarkable jump where the Section 8 rent is close to like the market rent. So there's some benefits there too.
What's up, Jake? Very courteous.
I did show up late. I thought I'd try to make up for it in some way. Hey, so when we moved up to Rhode Island, and you guys may have already talked about the housing market. I caught some of it at the beginning when I showed up. When we moved up to Rhode Island, we ended up in a 225 square room cabin with we had one light bulb, right? For 4 months with 5 people, 2 dogs, because we were unwilling to sign a contract that forgoed inspections and appraisals and everything else, right? We weren't willing to be insane, so we ended up in a cabin. Is it that bad yet down there? Because what I'm thinking about, my wife is thinking about, is when we come back there next year, we already have the property that you manage for us. The tenants are great. We don't want to kick them out, right? We are also not living in a cabin in the North Carolina swamp for 4 months either. So how bad is it down there for the buyers?
Yeah, it is not that far off from that. This is Benaya, by the way. It's not that far off from that in what I would say is your kind of normal upper middle class price range of high 200s to 400,000, which is, where most normal families, the price range here that they're going to be looking. There is so much demand that if you were going to try to buy a house that's comparable to your house on Chestnut Drive that we manage, you'd be spending significantly more and potentially competing with other people. But I think that is where what you just said and what Sean said earlier comes into play. If you have standards that you're not willing to lose, like waiving the inspections, and you don't want to put way more cash than the appraisal is going to come into the property, you'll be competing and you'll get outbid. Skylar and I personally, because we had the same standards, got outbid on 5 houses before we found this one off market and moved a couple weeks ago. So it took a lot to get there. Sean, you can also add to it.
Yeah, thanks. So I think a good option, Jake, would be to consider new construction. So new construction, there's a lot less demand for it because people in our generation wait till the last minute and they want something move-in ready. There's a ton of development going on here. There's a ton of homes being built. So if you're able to kind of, project out a little bit and start the process earlier, I think new construction is a good way to kind of prevent the stress and drama of, the buying process.
All right. Thank y'all.
Yeah.
We'll
Jake,
talk.
You don't have to live in a cabin. I got a tent in a big backyard for you.
I might could even rent the treehouse that I built in my tenant's backyard from them. Just take it out of their rent,
Yeah. They might ask a crazy amount given rent prices, but might be better than cabin.
Yeah. Anybody else? Anybody have any management specific questions? You don't have to. I always like feedback.
I guess I'll throw something out there. So I self-manage the property out here in Oceanside, and I do a buy the bedroom model, which, brings the gross revenue up a lot, but also a little bit more effort. Actually hasn't been, I'm surprised by how much demand there is in a place like this market. Do you guys see that type of model working in a place like Wilmington, where you've got young folks, you got college, you got grad students? Have you seen that ever or no?
Yeah, you go ahead, Skylar.
Yeah. So your question is there a demand to rent places by room from people that want to just live in a house in like one room? Is that right?
Yeah.
And what have you guys seen as far as, do you have any examples or experience with it?
Yeah. So you can take it, Avery.
I was just gonna say, we actually have a couple that we manage for an owner who's not in this group right now. And we've done by the bedroom. They are located near the military base. So Sneads Ferry, Jacksonville area. Single Marines are absolutely willing like that to rent a bedroom in a house with other single Marines. There's that trust factor. And it is more effort. It's definitely more effort. But the rents are definitely get pushed up. And so far we have not had any bad experiences of roommates not getting along. I mean, I vetted those just as thoroughly as when I'm doing a whole house. And that involves some, like letting potential applicants meet the other people who they'd be sharing a house with and that kind of thing. So I think it depends on where. In Wilmington, also because of the young professionals and college students, I think that, yes, it could do really well. And there, you just have to structure some things differently in the lease and in your, to help with maintenance issues and who's paying the security deposit and all of that kind of thing. But yeah, it's definitely something to consider.
No, that's awesome that you guys provide that as well. I've had a bit of a hard time out here finding PMs that are willing to entertain my idea. So it's good.
Yeah, we like being creative and doing what works. So,
let's see. We got a question texted in. Let me read this real quick. So, Crystal, do tenants ask for more maintenance when they see a sharp uptick in rents? You got an issue of this happening in Fayetteville. So, I'd say generally no. That issue is going to stem from uncommunicative property managers and bad relationships between the manager and the tenant. You said specifically, that it's not because the property manager is not responsive, but because they Googled that's what they should do. Yeah, the number one reason people move locally is because maintenance is handled improperly. Our goal is to get to every request within a day of submission. And the one thing you have to think about, and as managers, we take care of this when we talk to people. Just because rent prices are going up doesn't mean the product is any different. It's just the market demands that you get more rent. So if somebody moves into a fixer, or if somebody's living in a fixer upper, and I'll use an example from an inherited tenant, because those are the issues that we have when people are not screened properly or in a bad product. If you talk to them about, hey, this is what's going on, this is what we're going to do, your rent is this, you can't go anywhere else and get something cheaper, and you price it properly, they're not going to have issues. If they accept the product that it is, they need to know that that's what they're getting. So yeah, I'm going to raise your rent by 17%. I'm sorry. I'll give you a week to find somewhere else. And if you can't find anywhere else, then let me know, but I'm going to list the place on this date. And if they come back and they want to negotiate with us, we're not really going to entertain that, because we are managing the property, and the tail doesn't wag the dog. In the same light, though, when it's time to raise rents, if you need to do a capital improvement on something, a good thing to do with tenants that you want to retain is say, hey, we're going to raise rents. We know we need to fix some things. These are the list of items that we're going to do in the next 3 years. Which one of these would you like me to do for you? And give them a little option and buy-in. So they can be like, oh yeah, I'd love to have a new fridge, or I'd love the doors to be replaced, or the light switches or switch plates, etc. So planning ahead, and if you're going to have a really high increase with the same tenant, and there's a lot of deferred maintenance because you bought the thing with a renter in place and you're not in a place to make the property fresh. If you're going to spend the money, it's really effective to say, hey, let's do this. You're going to spend the money anyway, and the tenant thinks you're kind of doing it for them, and you get a win-win all the way around.
Yeah, and the shortest answer to your question, Ben / Crystal, is no, we have not had that ever happen. And I do think, not to toot our own horn, but it's because we really try to be communicative with all our tenants. And they all have, sorry, my kid missed his nap. They all have my number. It doesn't go to an automated call system or anything like that. They've got Skylar's number and my number, and we do regular inspections. We talk to them when things come up at the property. And so if there are issues, even if they're just unhappy about the rent spike, instead of internalizing that, getting angry, and then going to the city, we, for the most part, are keeping tabs on their emotions in general for whatever reason. And so they feel like they can talk to us, which doesn't mean we always say, yes, we'll do all this maintenance, but we do try to actually do things that need to be done that would be easy to kind of put off. And part of that is keeping tenants happy, because that benefits owners in the long run. They take better care of the property, less likely to turnover. Yes. The end.
Chris, oh, sweet. You're welcome. It's fun reading the message and answering the question. Anybody else got anything? No? Sweet. Well, Avery and I greatly appreciate you guys. Let's buy more houses together.
Sounds good. Thanks for everything you guys do. You're the best.
Yeah, you're welcome. Likewise, Sean.
Bye.
Later.
Bye.
Thanks guys.
Thank you.